Now that the Federal Reserve's rate hiking cycle is over, their next move for the effective federal funds rate is going to change everything, specifically for XRP, for Bitcoin, Chainlink, Ethereum, the rest of the altcoin market, the stock market as well too. So in this video, we're going to discuss what has happened every single time the Fed has gone from pausing rates to cutting rates, the most likely case scenario for this bull run cycle. We have to look at the effective federal funds rate compared to the S&P 500, the expectations for the September meeting coming up in the next month, how it's actually going to have the opposite effect that the majority of traders are expecting that's going to catch everyone completely off guard, how the Federal Reserve is expecting millions of American jobs to vanish in this downward revision. We have to take a look at the unemployment rate and exactly what is happening right now, expectations from Goldman Sachs and Wells Fargo, how far out we are from breaking the all-time high for Bitcoin to the US dollar compared to the last bull run, what the next major move will look like for the total altcoin market alongside XRP. Also, what Swift has to say about their GPI using APIs to enable distributed ledger technology, global settlement within their 11,000 member network, digging into what the code specifically says about XRP and how that's going to work, what former Ripple employee Marcus Treacher has to say about XRP's scalability with the help of the Interledger protocol, what I'm doing to earn an extra 1,000 to 2,000 XRP per day through the #1 play to earn XRP game and the #1 liquidity pool in the world on the XRP ledger. We have to talk about one of the major trends in crypto that is going to absorb a massive amount of liquidity over the next 12 months. A project that is absolutely exploding right now that you need to keep on your radar. That way you can make the most amount of money possible this entire bull run before the Fed's next major move. So comment 777 if you're feeling blessed, if you're feeling bullish, and if you're going to become the first millionaire in your family tree, you know what to do. Confirm it by tapping the subscribe button. Let's run it. All right, bull runners, welcome back to the channel. So let's dive right in and talk about what the Federal Reserve is about to do, because according to Reuters polling, they're expected to cut rates 3 times by a total of 0.75% this year. And this is creating a mixed reaction of expectations in the markets. For example, you can see this guy saying this down arrow should actually be going up. This guy is saying bullish. This guy is saying first it was 0.25, now 0.75. How aggressive do you guys want this to be? But ultimately, everybody is ready to see how this shakes up the markets. Because with the vast majority of traders expecting this to take place, let's discuss how this is going to affect the crypto market. If we look over the past day, we can see some projects up like Brett, WIF, Floki up, HTX is up, FET, Tron is up, Shiba Inu. The majority of the market is up, 1%, upwards of, maybe 20% for a few outliers. Whereas over the past month, the majority of the market is still down roughly 20 to 40%. And if we look at the effective federal funds rate, they've been paused ever since August of 2023 at 5.33%. So when we zoom out to max, there's been a few times in the past that this has happened where the Fed has gone from raising rates to pausing rates to cutting rates. The most recent was obviously 2019 to 2020. The time before then was 2006 to 2007. The time before then was 2000. And so let's discuss each of these times and how they have directly affected the stock market, because the crypto market is so relatively new that there isn't enough data to understand how it's going to affect the crypto market directly. But we can then study the stock market and look at the correlation to the crypto market and the most likely case scenario. Now, as always, it's not financial advice. These videos are purely for education and informational purposes only. Crypto is very risky. You could lose all of your money in these markets. And by investing in these markets, you have to be okay with losing absolutely everything. I create these videos to provide you with information. That way you could do your own research. So never buy or sell anything we talk about in these videos. Yes, I do hold positions in the cryptocurrencies I talk about because I'm only going to make videos about what I believe in. Why would I make a video about something that I don't believe in? That makes absolutely no sense. So by liking and commenting on this video, that means that you are okay with getting absolutely wrecked, absolutely destroyed, and taking responsibility for your own investment decisions, right? These videos are just purely for fun. So if we look at the Fed Watch tool, we can see the meeting is coming up on the 18th of September. 71% are expecting a 25 basis point rate cut to a 50-point rate cut. So it's most likely going to be 25 basis points if the Fed decides to cut. 28% are expecting a much deeper rate cut of 50 to 75 basis points. Now that would be very drastic. The only reason why I think the Fed would do that is if something breaks in the next month before the 18th of September.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So it would more than likely be a 25 basis point rate cut. So we'll see what they do. So let's discuss the effect that rate cuts have on the stock market. Then let's get into the correlation to the crypto market in the most likely case scenario, and then some trends that still have some appreciation until an absolute economic collapse and everyone loses all of their money. So when we look right here, you can see the Fed funds rate at the top of the screen, then the S&P 500. In terms of drawdown, the majority of the time that the Fed has cut rates, this has negatively impacted the stock market. Now, when though? Well, let's bring up the charts and let's talk about it. Let's also talk about the Dow Jones Industrial Average, because as you can see from October of 2023 on the right-hand side of the screen, the Dow has rallied from roughly 32,300 upwards of 40,000 while the rates have been paused. And so if we look on the left-hand side of the screen, we can see Bitcoin right now. Bitcoin has rallied as well too, up until, obviously March, and then we're seeing this correction take place right now. So how much higher could Bitcoin go when the Fed decides to cut rates? What's going to happen? Well, let's go back on the right-hand side of the screen to the last time that the Fed went from raising rates, pausing rates, cutting rates. I've talked about this before, but I'm going to give you some nuance points in this video, because as you can see right here in August of 2019, when the Fed decided to cut rates for the first time, there was initial shock in the market and the Dow crashed about 7 or 8%. And then it rallied on out of here while the Fed was cutting rates over the course of 90 days. So for 3 months, they had consecutive back-to-back rate cuts. That's why it looks like a stair stepper, because they don't just cut rates every day during that month. They cut it once and then we have to wait till the next meeting. Then they either decide to cut it again, raise it, or keep rates steady. So in this case, they cut 3 times in a row. There was this little blip right here. But ultimately, what happened during that period, especially from November of 2019 until they really started cutting rates again, March of 2020, they kept the rate steady. The markets rallied for about 195 days after that first initial rate cut. So let's say the Fed decides to cut the rates by 25 or 50 basis points in September, and that creates an initial shock in the market, shakes Bitcoin out to $50,000, another shakeout. Let's just say, hypothetically speaking, that happens. Well, as you can see on the right-hand side of the screen, the first initial reaction was shock, but then the markets rallied while they were cutting rates because then everyone expected it. And if we were to measure roughly 195 days on the left-hand side of the screen, that would put us into April of 2025. Then what happened after that was the stock market started to collapse because unemployment, that I'm going to share with you in a little bit, started to spike up. The pandemic took place, and then the Fed was late in dropping the rates after that. They were holding them steady for a long period of time. Then they had to respond by cutting rates to stimulate the economy. But by then, they were too late because the Dow had dropped all the way down to about 18,000 right here, plummeting nearly 40%. Now, as you can see on the left-hand side of the screen, while this was taking place and the Fed was cutting rates, Bitcoin was in a downtrend during the period where they had rates paused from November 2019 until 2020 when they rapidly started cutting the rates. Well, Bitcoin attempted to make a recovery from $6,800 upwards of about $10,000. So it couldn't pass the high of 2019, whereas the Dow was breaking out to an all-time high and then ultimately crashed over 60% when the Fed was late to cutting rates. And so the correlation that we could see within the crypto market to the stock market is actually way more volatile on crypto. So crypto gets hit a lot harder. Now, if we were to zoom out even more, there's no other data that we have in the crypto market for when the Fed went from raising rates to pausing rates to cutting rates, other than what happened from 2019 to 2020. So the only other data points that we really have to look at is the stock market. And so far we're 1 for 1 in terms of correlation between the rate cuts and a market crash for the stock market, a crash for the crypto market after the Fed cuts rates. Looking right here, going back to 2007 to 2008, when the Fed first started cutting rates by like August of 2007, the first initial reaction was shock in the market. The Dow crashed about 8%. And then 57 days after that first initial rate drop, you can see that the rates were all over the place. The Dow rallied for about 57 days to a new high. And then after that, it was all downhill from there. As you can see, they kept lowering the rates, and then the market was in a full-fledged bear market, an absolute collapse from that point. There were periods of time where it recovered over the course of 19 days right here, rallying up 8%, 70 plus days right here, rallying over 11%. So during a bear market, there are periods of recovery, but if you're trying to make money in a bear market, buying these dips and then trying to sell on these retracements, you're basically catching falling knives at that point. And ultimately, you're just better off doing what Warren Buffett did, sitting in bonds and then just waiting for the bottom to buy this dip all the way down here. if you're trying to make money in the stock market, I'm not investing in the Dow or the S&P 500 indexes, which basically tracks a large chunk of the stocks, but it's ultimately driven by the main 7 tech companies. If we were to measure 57 days after September 18th, that's roughly the middle of November. So the first data point that we have for the Fed cutting rates, it was 195 days after they started cutting rates that the Dow rallied to a new high and then crashed after that. The next data point is roughly 57, almost 2 months that it rallied to a new high and then crashed after that. Going back a little bit further is December of 2000 when they started cutting rates and then dropping them all through 2001 until 2003. You can see the first initial reaction was shock. The market crashed about 5%. Saw a little rally up, and then they started rapidly dropping them. It crashed all the way down here to 9,000, dropping 16%, and then the markets got used to the rate cutting, rallied back up, formed a new high, and then ultimately when the Fed was continuing their rate cuts, the market crashed with it, and then we just saw this fall off a shelf down here with the rate cuts, and then they bottomed out all the way down here by August of 2003. The markets had crashed and found a bottom before then, with these recoveries taking place after the Fed had just nuked the rates down to virtually nothing. So after the Fed started dropping rates in December, then all through 2001, it was about 141 days that the Dow Jones rallied up to a new high and then just ultimately downtrended from there, fell off a shelf, and just wrecked people in that first initial drop, crashing over 28%. Then we saw this massive recovery, and then it just rolled over from there. People thought the markets were going to recover from here. Nope. They had to wait all the way until the bottom, which was what looked like October of 2002. And even then, it tried to recover up and then crashed back down for a double bottom by March of 2003. So for about 6 months, the Dow rolled over and then shaked everyone out another time before finally starting to make the recovery after March of 2003. So if we go from roughly September 18th and we were to measure out 141 days, that puts us to about February of 2025. Now, as you guys know, I talk about facts in my videos, and if that makes you feel some type of way, then I don't care. And the markets don't care about my feelings. They don't care about your feelings. All that they care about is the facts of the matter. And the fact of the matter is the Federal Reserve could see millions of jobs vanish in this downward revision, where a report notes that Goldman Sachs and Wells Fargo economists are predicting payroll growth revisions through March, where 600,000 is weaker than estimated. This would equate to 50,000 less jobs a month. Additionally, the former expects a decline as large as 1 million. So that would indicate that the US labor market has been cooling for some time. Specifically, it would have been slowing down for far longer than the Fed had thought. And so this next speech from Jerome Powell is going to be the most important speech over the past few years. If we look at the unemployment rate, it has been curving up. If I zoom in right here, you guys can see that the bottom was right here in April of 2023. Joe Biden was bragging about low unemployment, which is not good because once you're at a low, the only place to go from there is up. And every single time we're going to discuss this, that the unemployment rate has spiked, we've seen a crash in the market. So April of 2023, 3.4, where we're at right now, 4.3 for July. And then June was 4.1, May was 4.0, August was 3.9. So we're starting to see unemployment curve up. The last time that this took place, it was more rapid, February of 2020. Like I just showed you guys for COVID, the market crashed, crypto crashed over 60%. Unemployment spiked from like 3.5% to 14.8 by April of 2020, which was the most drastic spike in unemployment in history. The time before then was from April of 2008. We went all the way up here by October of 2009 and 10. That was the subprime mortgage crash. The time before then was 2001 when they were cutting rates. So people think that cutting rates is actually good for the economy. No, it is absolutely horrific just based on facts. This is not even a theory at this point. The last time it was horrific. The time before then, it was horrific, which I feel indifferent about, right? Because we need to control our emotions here. The time before then was 2001. It was horrific. The time before then was July of 1990. If we just go ahead and zoom in for this phase right here, we went from 5.2 in June of 1990. Then we really started to escalate by March of 1991. And as you can see right here from the right-hand side of the screen, from the end of June of 1990 to July, the markets rallied up a little bit further to about 3,000 for the Dow Jones Industrial Average, and then ultimately crashed over 20% during this period right here when the unemployment rate was spiking. So unemployment going up while the Fed is drastically cutting rates is not good for the stock market, and theoretically, it would not be good for the crypto market. Now, this would go against the 4-year market cycle theory and also what a lot of people are saying about global liquidity. So I just find this very interesting. I'm curious on your guys' thoughts here because we're going to discuss this more in detail throughout this video, looking at Bitcoin to the US dollar price chart based on the monthly, and then we're going to compare to altcoins and XRP because how long it took Bitcoin to break out from the previous high on the monthly and have a candle close above the all-time high was back in December of 2020. It was at roughly 1,095 days, right? I can't measure on the exact month here. And so if we were to go from the high of November of 2001, 1,095 days is roughly around the 1st of November of 2004 for Bitcoin to break out. So if the Fed decides to cut rates in September, and then in November, the Fed Watch Tool is expecting another rate cut, and then in December, it's expecting an even deeper rate cut. And then by January of 2025, it's expecting a deep rate cut. Same with March of 2025. April of 2025 is even deeper. June of 2025 is even deeper. Then by July of 2025, if they just keep cutting rates, something's got to break in the economy, according to this. But we do have some good news for you. There is still some time to make some money. As you can see right here, the last time that the Fed did this in 2019, there was about 195 days where the markets had this parabolic blow off top before collapse. The time before then, between August and October of 2007, it rallied for about 57 days. And then before then, there was another rally of like 100 plus days. And so when the Fed starts cutting rates, the first initial reaction could be shock. We could see another shakeout event in the crypto market and in the stock market. And then we could see the markets rally for a period of time. And then depending on how quickly the Fed shifts from quantitative tightening to quantitative easing, with the money printer, global liquidity increasing, will really determine how parabolic the rally is before the collapse. If we look right here, Bitcoin has had the same number of users as the internet had in 1999. So according to Vivek, we're just getting started in the adoption curve. And if we look at the Bitcoin price chart compared to the crypto total market cap compared to XRP, well, if Bitcoin starts to break out, makes this parabolic rally, and the Fed cuts rates, and then Bitcoin starts to go rapidly to the upside, we know that it's on. And this is the last chance to make money in the crypto market before a collapse takes place after the Fed goes through the rate cutting cycle based on the past. And if we look right here, 1,095 days, Bitcoin broke the previous high back in December of 2020. Well, how long did it take the altcoin market to break its high? Well, it was 54 days after Bitcoin broke its high, and the altcoin market was playing catch up as money was rotating from Bitcoin into altcoins. But by then, Bitcoin had rallied over 100%. And during that 54-day period until the altcoin market broke out, well, the altcoin market rallied over 179%. So actually, while Bitcoin was breaking its all-time high, even with the altcoin market still underneath its all-time high, there was more gains to be made in altcoins. If we look at XRP, it took XRP 111 days to break the high of November of 2020 before the lawsuit was filed. Obviously, XRP didn't break the all-time high because there just wasn't enough gas left in the tank because of the lawsuit, the price suppression. But nonetheless, the important thing to note is that altcoins rally after Bitcoin has broken its all-time high, because Bitcoin is the market maker. Bitcoin is the main currency that trades against these altcoins. And so if Bitcoin's going sideways or down, altcoins is going sideways or down even more. If Bitcoin's going up, altcoins go up even more. And the altcoin that is the most popular in the world is XRP, and that's not even debatable. I know there's certain trends right now like Solana, meme coins, real world assets, artificial intelligence projects, but XRP is the only cryptocurrency that went through that legal battle with the SEC that was that intense. So Ripple was there and XRP had to go through the fire because it is the most valuable cryptocurrency that is seen as a threat. Because anytime there's new innovation in a species, the first reaction is opposition, meaning that when natural medicine started coming out, when doctors were putting leeches on people's bodies and women were the ones that administered that medicine, they were called witches and they were burned at the stake. When the automobile came out, everyone was used to scooping up horse poop all over the road, that they didn't even want cars and they were too expensive for people. They're like, why would I spend all that money when I have my horse here? I like my horse. I don't want to get rid of my horse. Plus, there weren't even many roads made that were suited for cars. The roads were suited for horses. It's the same thing in the banking industry right now, because the current road of the payment rails, so to speak, is through Swift. Now, Swift has over 11,000 members in their network. They mentioned the partnership with R3 Corda, which uses XRP for payment settlement, which is confirmed right here by the R3 Corda's technical code, where you can see XRP Oracle service, XRP payment, XRP settlement, Swift service, token type. You can also see it within Swift's official documentation of settlement on Corda. You can see company A, company B, trade transaction, the need for settlement, and then Corda Settler has transfer of funds on Corda, Swift GPI, cryptocurrency. Right here, the only example that they give is XRP, and then the GPI link. Also, we can see it right here on Credit Suisse's institutional document when we zoom in, when they talk about cross-border business-to-business payment pain points that are a big problem to be solved. Well, they have Ripple listed here, 300 financial institutions using the platform RippleNet, which provides an option to use XRP. We can also see R3 here offering Corda Settler, which supports XRP, partnering with Swift on standards, global banking innovation, Swift GPI, Bank of America recently joined MPN.
My last question is really about emerging technologies, such as APIs and distributed ledger technology. How is that making an impact on cross-border payments?
Well, APIs are a great technology that allow corporates to unlock value. And with GPI, we built in APIs deliberately from the outset, so that banks can indeed integrate that tracking information into their portals, and their clients can benefit directly from this visibility thanks to APIs. We're also using APIs to further integrate the GPI experience into DLT, distributed ledger-based ecosystems, or other ecosystems that want to benefit from the global settlement capability that GPI banks provide. In that context, we recently partnered with R3, the blockchain infrastructure software provider, so that their Corda Settler can support Swift GPI for this purpose. But actually, it's not so much about technology. Technology is more a means to an end. With Swift GPI, it's more about providing the ability to provide an enhanced experience, to reduce the friction of these payments, to increase their speed. That is actually what Swift GPI delivers.
So what we're going through right now is the fourth turning, and it's usually followed by war. So World War III is coming. Just get ready for that. And you need to have enough money to be able to financially support your family, to buy land, to buy water, buy food, have different resources, passports to other countries. Because if you look at what happened from 1910 to the 1920s, there was mass production of cars. The inclusion of the assembly line by Henry Ford in 1913 made cars more affordable and accessible to the average person. The Ford Model T, introduced back in 1908, became especially popular and played a significant role in the widespread adoption of cars and the decline in the use of horses for transportation. By 1920s, cars were becoming more common in cities and rural areas. Horses were still used in some regions, particularly for farming or other specific tasks. But by the 1930s to the 40s, this was when the widespread adoption of cars took place. They became the dominant mode of transportation in many parts of the United States and Europe. Infrastructure like roads and gas stations expanded to support the growing number of automobiles, and that's where we saw the main gas companies come out for monopolies, burn down the electric, natural energy factories. And by the 1930s, cars had become the dominant mode of transportation in many parts of the United States and Europe. That's what we're going to see with distributed ledger technology, blockchain technology within banking. And then by the 1940s, the use of horses for everyday transportation had largely disappeared in urban areas. And then after World War II, car ownership expanded rapidly worldwide. In many countries, the transition from horses to cars was complete by the 1950s and the 1960s. So from the point where the Ford Model T was introduced in 1908, by the 1950s, after the war, cars had completely taken over. So about 40 to 50 years later, that's exactly what we're going through right now with cryptocurrencies. Now, interestingly enough, if we look at when Bitcoin started, it was launched in January of 2009 by Satoshi Nakamoto, or as a lot of people like to say, the National Security Agency. So when I say the fourth turning, look at what happened in 1908. The Model T came out. Then the assembly line came in 1913, just 5 years later. What are we seeing happening in banking right now? Virtually an assembly line for distributed ledger technology to make the transfer of funds a lot more efficient, just like we made transportation a lot more efficient in the 1900s. So a lot of people get impatient because they're living day to day when they're not zooming out and they're not thinking over the next 10, 20, 30, 40, 50 years. So what XRP is designed for is your kids' kids' kids. It's a generational play, guys. Listen to what former Ripple employee Marcus Treacher confirmed about XRP being infinitely scalable within the help of the Interledger protocol, and that the liquidity model of XRP was meant to scale to 7 to 9 billion people.
We've configured our technology in a way that really fits the problem of cross-border payments liquidity very, very well. So for the cross-border payment challenge, we've created an open internet model. We call the idea interledger. So interledger, like the internet, supports our Ripple technology globally. And that model does not require a single universal common blockchain. It requires a very open blockchain interconnectivity. And that means that the volume is theoretically infinite. It's like the internet never runs out of capacity. Elements do, but the internet still works because it's inherently decentralized. So Ripple is the same. So we have a decentralized model which is infinitely scalable. Supporting that, we have our liquidity proposition, which uses XRP, and that's a classic blockchain. But XRP was designed from the outset for transacting. So unlike the likes of Bitcoin, which is like very slow and slows down as you continue to build on volume, the XRP model is very, very, very high speed and very high capacity. So the liquidity part is very adequately served by the XRP model. The wider network we're creating, where if you're really going to create something of value for the 7 billion people in the world or 9 billion by 2050.
So the number one way to benefit this entire bull run while Ripple gains more adoption as a company and XRP either goes sideways, down, or it goes up in the short term is through the XRP Ledger automated market makers. Basically, the automated market maker provides liquidity in the XRP Ledger's decentralized exchange, and each AMM holds a pool of 2 assets, and you could swap between the 2 assets at an exchange rate set by a specific formula. And how the automated market maker works is super simple. The AMM holds 2 different assets. One of them can be XRP, and another one can be any other token on the XRP ledger. And whoever creates the AMM becomes the first liquidity provider and receives LP tokens that represent ownership of the assets in the AMM's pool, and they can redeem some or all of those LP tokens to withdraw assets from the AMM in proportion to the amounts that are currently there, and the AMM doesn't charge a fee when withdrawing both assets. And one of the biggest benefits of this is being able to put your XRP to work for you to earn trading fees as a source of passive income by being a liquidity provider. So if you want to learn more in detail how this works, I'll leave a link in the description below this video. It'll take you to a page that looks like this, and you'll see instructional videos about the #1 liquidity pool on the XRP ledger that I'm currently leveraging to earn an extra 1,000 to 2,000 XRP per day in trading fees. On top of that, you'll learn about the #1 play to earn game on the XRP ledger that has an in-game currency that I talked about a month ago when it was at about $50. And since then, this project 2x to over $100. And the reason why is because the game is so simple, it literally takes less than 10 minutes per day to play. So when you go through the link in the description below, you can get your digital game pieces, and these digital game pieces earn crypto rewards, and they can collect rent each and every single day in the native in-game currency that is currently sitting at about $97 right now at the time of making this video. And as you can see, over the past few days of playing this game less than 10 minutes per day, I've earned over 31 crypto, and I have over 204 crypto right here over the past month. So if I take the total crypto that I own right now at about 204 and I multiply that by the price, let's just say $100, that's roughly $20,000 worth of crypto rewards for playing this game. Now, obviously results aren't typical. I'm not guaranteeing that you're going to earn the same amount, but the coolest thing about this game is the liquidity pool that's paired to XRP is the #1 in the world on the XRP ledger, and I take roughly 8 crypto per day, and I add that to the liquidity pool to earn trading fees. I simply slide to accept on my XRP wallet. It says transaction was successful, and I can remove liquidity at any moment that I want, whether it be in crypto or in XRP. So let's say I want to remove 1,000 XRP, that's roughly 38,000 LP tokens. If I want to remove 2,000 XRP, that's roughly 76,000 LP tokens. So every day that I add between 8 and 9 LP tokens, I get close to 55,000. I can remove that as either crypto or XRP simply by playing this game less than 10 minutes each and every single day. So all you need to do right now to get access is click the link in the description below this video. It'll take you to a page that looks just like this. Watch this 8-minute video on the other side. We'll show you how to get your XRP wallet, how to get your game pieces, how to play the game, and how to withdraw crypto every single day to add to the liquidity pool to compound your rewards. That way you can benefit from the #1 play to earn XRP game this entire bull run before this project absolutely explodes. Because when we look at the XRP price chart compared to the effective federal funds rate, the XRP price has been suppressed. And so if we see a breakout for Bitcoin and the stock market to a new all-time high anywhere between 50 to 150 days after the Fed starts cutting rates, well then I would expect XRP to surge. Now another industry that I expect to surge would be the decentralized finance industry, because after being pushed aside by other narratives like real world assets, artificial intelligence, gaming, and even meme coins that have virtually no utility, there are signs of a DeFi resurgence going on. So let's take a look. First up, the mindshare for DeFi in general has been on a 3-month uptrend, close to doubling in percentage from 7 to 14 since the start of this year. Out of all the DeFi projects, the two gaining the most mindshare percentage-wise out of any of the past 30 days are Aave and Drift, whereas Aave has been the outperformer in terms of price, mindshare, and sentiment too, closing in on its March high and sentiment higher than any time in the last 12 months. And here's a summary from AI Copilot on why people are so bullish is because of new proposals, strong usage in terms of borrowers and depositors, significant liquidation fees during market downturns, which leads to max revenue. They're the top lending protocol on multiple networks. There's big safety enhancements, reduced selling pressure. There's a real community, growing potential, and DeFi has been resurging. As the risks for more potential bank runs take place, that money is just going to flow into decentralized finance because people just don't trust the banks after they've seen what happened with Silicon Valley Bank collapse and the other major banks that collapsed while the Fed was cutting. And so that brings me to this project right here, which is DeFi Technologies that I talked about in a previous video, which bridges traditional finance and innovative exposure to digital assets with institutional grade ETPs, which are exchange traded products, which are available via traditional banks and brokers over in Europe. So DeFi Technologies is the parent company in Valor Asset Management. As of August 8th this month, they recorded over 609 million USD equivalent, and that's roughly 837 million in Canadian dollars. And then DeFi Technologies, in terms of their cash and digital asset equivalents in 2004, they had 97 million USD equivalent, which is about 133 Canadian in millions of dollars. And if we look right here at their recent Q2 report for this year and their financial results, they set a new record, marking the company's strongest quarter to date. And we talked about this in a previous video. If you guys watched that, their total revenue, about 98 million US dollars across all business lines. The assets under management growth was 43.7%. In terms of treasury, the company held 54.5 million in USDT and 110 Bitcoin, totaling 9.2 million. The company's venture portfolio investments were valued at $41 million as of June. And then looking ahead, the current assets under management, about $610 million as of July 31st. Current cash and USDT balance is about 56 million in Canadian, 40 million US dollars, and the company remains significantly undervalued with a current market cap about $500 million. When you consider the following, that their 2024 revenues of 131 million, driven by strategic initiatives and continued product innovation, focusing on their ETP business. Now, as you guys know, exchange traded products and ETFs are hot right now in the crypto space. And Valor Funds, based on current asset prices, and this does not include revenue from DeFi Alpha or the additional 19.3 million Canadian dollars in arbitrage trading already generated in Q3. They've established a very strong foundation. They're confident in the opportunities ahead because they're constantly adding other crypto assets to their portfolio. And if you look at the price right here, in terms of the ticker, it's DEFTF, DeFi Technologies, right here on TradingView. You can see it's at $1.72. I was talking about this at about $1 all the way back here at the beginning of the month. So it's up right now over 64%, and it's still currently off from the all-time high of about another 100%. And so if the bull run is still intact and Bitcoin breaches to the all-time high and money starts flowing into the altcoins, I would expect DeFi Technologies to do very, very well this bull run. Now, as always, I'm not going to make any guarantees of where this could go to in terms of price, but I personally believe it's drastically undervalued right now. And that's why we decided to partner with them as the sponsor of today's video. And as you guys already know, we only accept sponsors on this channel that we believe will do well. And thus far, it's up over 60%. So if you would have listened to that first video earlier this month, you'd be doing very, very well. And as we can see right here on the 50-day SMA, it's still above the 200 SMA in this healthy uptrend right now. And as you guys know, the trend is our friend right now. The MACD is in an uptrend. You can see the MACD line in blue is still above the signal line. Now, obviously we want to watch as we get more overvalued up here for a potential bearish cross, but it's good news that the MACD line is still above the signal line. Also, we can see on the weekly chart that the 200 is above the 50 SMA. We could potentially see a golden cross take place here. The last time that we saw a golden cross was right around January of 2001 when the price went from 61 cents all the way upwards of $2.50. So that was roughly over 300%, and then it ultimately topped out over 500%. And so what we look for is bearish crosses on the MACD on the larger time frames before we start to see a major correction where the MACD line in blue just gets drastically overvalued and then crosses the signal line in orange, and then we start to see a downtrend take place. And you guys can see it happen multiple times in the past. And so what we're going to look for is we're going to look for the MACD line in blue to get drastically overvalued all the way up here, the signal line in orange to cross above it. And then once the MACD line in blue crosses below the signal line, we could see the next major correction to the downside. And then depending on where we are with the Fed funds rate, where we are in the macro market cycle, we could potentially see a massive blow off top somewhere past the all-time high before we go into a bear market in 2026. So my take on the market right now is that there's still gas left in the tank. Depending on what Jerome Powell says in September, it might actually be more bullish than a lot of people think, because if they drop the rates 25 basis points, there might be a shakeout in the market, a little short-term temporary correction. But just like the past 3 times in the past, we've seen a rally post rate cut for anywhere between 50 and 150 days. And so that would put us into 2025, which for me would signal that the top is going to be somewhere in the middle towards the end of 2025. And we're going to go into a bear market in 2026. And it's going to be the most disgusting crash of all time. So if you're paying attention right now, now is the time to capitalize. Now is the time to prepare. And now is the time to go to bullrunners.com. Click the button on the page, put in your best email address to subscribe to our daily video newsletter to receive news like this to help you guys understand what's going on in the markets. And also you'll be able to discover how to earn more crypto in less than 10 minutes per day with the #1 play to earn XRP game and the #1 liquidity pool in the world on the XRP ledger. Because rather than just sitting back, relaxing and waiting for XRP to go up, we're putting our XRP to work for us so we can be able to generate massive crypto rewards. As we back up our trunk all the way to the bank, grab the bags, pack them and stack them, leave no bags left behind, because we believe the spending power of the dollar is just going to keep going down in value. That's a fact based on inflation. Blockchain technology, distributed ledger technology, and cryptocurrencies have been going up in value over the past decade. That's the truth. And together we're all going camping on the beaches of the moon. So I'll see you guys in the next video. I will see you on bullrunners.com. As always, you know what to do. Stay bullish.